Hello, and thanks for taking time to watch our webinar. We know that you want to be savvy with your money, and to do that well, you need resources and good counsel. The problem that we see is that many financial advisors fail to incorporate tax strategies into your overall investment planning strategy, which means that you could be paying more in taxes than you really need to be paying. We realize that everyone has a vision of what their successful future could be, which is why our goal is to help you achieve yours, just as we have for hundreds of other clients. Today, we will be discussing a retirement savings strategy with the goal of significantly reducing your overall tax liability, not only for this year, but hopefully for years to come. I will be speaking on the topic from a retirement savings standpoint, and later, Mike Ocker, CPA, owner of Ocker Accountants and Consultants, will be diving a little deeper into the tax saving possibilities that this strategy can provide. To start out, I'm going to kind of give a broad overview of the strategy and just kind of talk about what we're going to be discussing within the strategy. So the strategy we're reviewing today involves the implementation of a retirement plan vehicle referred to as the solo 401k into your overall savings and tax planning strategy. Also, along with the possibility of maybe looking at incorporating your business and filing as a subchapter S corporation if you are not already doing so. I will be discussing the 401k part of the strategy, and Mike will be talking to you about the benefits of filing as subchapter S and when you should consider this, as well as the overall tax benefits of the plan. So the first part here, I'm gonna dive into a quick explanation of what a solo 401k is. And for many of you, you've probably participated or may have participated in the past in a 401k plan at a place of employment. And basically, this is the same concept. It's the same type of plan. Really, there's just one minor difference. And that difference is that with the solo 401k plan, the only participants that are allowed to be in the plan are yourself, your spouse, and your kids. Those are really the only that's really the only difference between a solo K and a traditional 401k plan. The solo 401k still provides the same contribution levels that a regular 401k does. So as an individual, if you're under 50, your max contribution on an annual basis is $19,500. If you're over 50, you do get the benefit of a catch-up contribution, and that increases your ability to defer up to $26,000 a year. The unique thing about the 401k that you may not have with other types of retirement plan vehicles is that the 401k gives you the opportunity to give yourself a profit sharing contribution. So basically, if you have a really good year, you have the ability to say, hey, I'm gonna give myself a chunk of money as profit sharing, which then allows you to defer as much as $57,000 a year if you're under 50, and $63,500 a year if you're over 50. So you can see with these dollar amounts, you know, that's a sizable amount of money that you can defer pre-tax into one of these vehicles, one of these solo 401k plans that other retirement vehicles do not provide to you. We find that you know, many individuals aren't aware that these even exist. So it's a pretty powerful tool with regards to the ability to defer large amounts of income pre-tax on an annual basis. The other kind of part of the 401k plan is that it also allows you to do Roth contributions. So Roth contributions, just a quick note on those are contributions that are made after tax. They grow tax deferred, and then distributions from them in retirement are completely tax-free. And some individuals, it may make sense to do some of their contributions as Roth. That's kind of you know, an individual kind of thing. It's something where we would sit down with you and talk to you about your total income and goals and so forth, and determine whether or not, you know, pre-tax, 100% pre-tax makes the most sense, or maybe a combination of pre-tax and Roth makes the most sense. Each client is a little different, and you know, we meet with you to determine what is the best strategy for you with regards to which bucket you're kind of putting your funds into, if you will. The other nice part about the solo 401k plan is you're able to set this plan up with loans and the ability to take hardship withdrawals. So what that means to you is, you're putting money in this plan, and if a situation should arise where you need funds and you don't have many options, the solo 401k is something that you can fall back on and actually borrow money from yourself and utilize those funds in a situation should you need to. We typically don't recommend doing that. It's not really a great option, but sometimes it's your only option. So the funds are available to you should you need them down the road. So now I'm going to talk a little bit more in depth about the tax benefits of deferring income into the solo 401k. I'm just going to provide some basics, and then Mike will kind of dive more into the specifics of the tax savings and give you some examples of what kind of savings you can see. So the main goal here is to defer while you're in a higher tax bracket. Generally speaking, when clients are hitting a 22% bracket or higher, it starts to make sense to start putting income away on a pre-tax basis. Generally speaking, when you hit the higher brackets, the goal there is to defer income when you're in those higher brackets. And then in retirement, hopefully in a lower bracket, you pull it out and you have a savings there. So if you defer in 22% bracket or higher during your working years, and then in retirement years, pull it out at maybe a 12% bracket or lower, there's a significant savings in tax on those dollars, deferring them while you're working and then withdrawing them in retirement. So what are the income levels there? Many people don't realize, how the tax system is set up and, how income tax rates are bracketed based on income. So generally speaking, if you're a single individual, you start hitting the 22% bracket when you get to about $40,000 a year. That's after deductions. And as a married couple, it's about $80,000 a year after deductions. That's the top of the 12% bracket. So if you're kind of exceeding those figures, that's when this strategy can really have the most impact in terms of tax savings for you. So those are the kind of the numbers that we throw out there that is, as a single person or a married person, if you're over that $40,000 or $80,000 a year, this strategy we feel is worth taking a look at and determining whether or not it makes sense for you to utilize this as part of your overall financial strategy, tax strategy. The other big impact of this is if you really have a good year, you have the ability to hire your spouse as an employee and defer additional dollars. If you remember, I said earlier that you could have your spouse and your kids as employees within this 401k plan. So if you hire your spouse onto the plan and pay them, again, you can defer up to an additional $57,000 under 50, 63.5 over 50. So if you're a couple over 50 and you have a really good year, you have the ability with one of these plans to defer, in excess of $125,000 in a year's time. So you can see how, being able to defer those dollars pre-tax at those kind of figures can provide some pretty exceptional tax savings for you in any given year. The one thing you have to take into consideration is if you have a spouse who also works another job and they do participate in a retirement plan at work, we have to take that into consideration for their total contributions. And obviously that's something we give you guidance on, and we make sure that you're staying within the rules. But just to let you know that if that's the case, you do need to take those contributions into consideration when you're implementing this plan. So just a couple quick kind of client examples. Recently we had a married client. They were hitting the highest tax brackets. We implemented this strategy for them, and for this tax year 2020, it's anticipated that it's going to save them over $40,000 in federal taxes in 2020 alone. So, I mean, you can see that it can be pretty impactful. So you're taking money, you're putting it into a plan. It's still your money. It's all your money, but you're reducing what you have to pay into the IRS by, a considerable amount. In this case, $40,000. Now, that's kind of an exceptional case. Most clients that we see implementing this strategy at various funding levels, on average, we'd say they're saving somewhere between $10,000 and $20,000 per year in taxes, depending on those contribution levels and what brackets you're hitting. But generally speaking, that's roughly what we see as a tax savings for individuals. So this is something that, we can sit down, we can analyze this for you and kind of give you a sense of, here's what we would anticipate you saving if at different price points or different contribution levels, I should say. And again, just to tell you, it's still your money, and you're paying yourself and reducing what you're paying the government. So that's the whole key to this. That's what we're trying to accomplish for you. So that's kind of a general overview of the 401k aspect of the plan. So now I'm going to pass it over to Mike. Mike's going to kind of run through a scenario with you where he's going to show different scenarios where, you're just filing as a sole proprietor, as an S Corp, and then as an S Corp implementing this 401k plan into your strategy, and kind of show you what those figures look like and talk a little bit about the S Corp as well. So with that, I'll pass it over to Mike.
Thank you, Greg. Hello, everyone. Thank you for joining us today. I just wanted to take a moment to jump back what Greg was speaking to. The number one tax planning strategy that we use is for small businesses is to incorporate retirement planning into that tax strategy. And his evaluation was spot on. I always explain to the client that a retirement plan, you're simply taking it from one of your accounts and putting it to the other account, and the government is going to give you a rate of return of 22, 24, or upwards of 30% for that. So we always look at retirement planning first. We work with your financial advisor to select the right plan. Today, we're going to specifically speak about the tax planning with the solo 401k, and also looking at filing as an S corporation. For some of you that are a Schedule C filer, what we try to do, Schedule C sole proprietor, what we look at is once your Schedule C profits hit somewhere north of $50,000, we start to analyze whether or not the S corporation would be beneficial to you. Here we're looking at a screen where the first column, sole proprietorship 2021. The middle column is we're going to go through that as taxed as an S corporation. And then the third column is going to show us the S corporation with the solo 401k and evaluate each of those from a tax perspective. So if you're an LLC, sole proprietorship, and you have over $50,000 in profit, what we first look at is the cost benefit to converting you to an S corporation. And what I mean by that is you're going to have higher tax prep fees because there's a separate return that's going to have to be filed. You're going to have payroll tax returns to file. You're either going to have workers' comp or elect out of that. You're going to have state unemployment to pay. So those factors are built into our evaluation whether an S corporation makes sense for you. And really it comes down to, we like to see after the cost, the benefit should be, $4,000 or $5,000 in your pocket to make the move, because there is some significant with payroll taxes and also some compliance issues that you have to follow with the S corporation that you would not otherwise follow. So if we look at the example on the screen and we look at the sole proprietor, we see for this example we're using $150,000 across the board. So $150,000 sole proprietorship, we see that we have an adjusted gross income after the self-employment tax of 139,403. We use the standard deduction and take the qualified business income deduction. That gives us taxable income of 101,482. Next slide, please. So if we look at this, the tax on that is 18,377, and then we add in the Social Security self-employment tax for a total federal tax of 39,571. So a sole proprietorship single member LLC is going to see about $40,000 worth of tax, federal tax on that example. So if we go back to the first slide, thank you. Now, this middle column, we're going to look at the 150,000, but we're going to break out 50,000 in shareholder wages and $100,000 of profit. So we're dealing with the same amount of income. You will have payroll taxes on that 50,000, as I said, but the $100,000 of S corporation profit are not subject to Social Security tax or local income tax, thereby giving about a 17% tax savings on that $100,000. So we go down through the same scenario where we have 150 adjusted gross income, the standard deduction, and the qualified business income deduction. We're getting taxable income of 117,450. That gives us tax on taxable income of 22,209. So you see, without the Social Security deduction and the smaller qualified business income deduction, the federal tax on that is higher. However, there is no Social Security tax because it's paid in with the W-2. We estimate the payroll taxes to be about $4,000. So you can see the bottom line of that screen. You have gone from about 40,000 to 26,000 in that example for your overall federal tax. So we go back to the first screen. So now we were an LLC, sole proprietor. We elected to be taxed as an S corporation. Now, if we incorporate that 401k into the picture, we're looking at the same 150 profit. However, on the W-2 wages, we have elected to defer the maximum 19.5 into the 401k. And then we also can defer 37,500 into profit sharing. So that knocks our overall adjusted gross income to 93,000. And then we take the standard deduction. The qualified business income deduction, you'll see, is lower in this case as well. That gives us taxable income of 67,950. And the tax on that is 10,703, no Social Security tax with the S corporation. So you can see the significant tax savings that you're getting from that 19.5 W-2 deferral and the 37.5 profit sharing deferral. Your total tax is down to approximately 11,000 for federal income tax. So you can see where it goes from 40,000 to roughly 15,000 if you're looking at the very bottom there of payroll taxes. Now, just to step back a moment, if you are an LLC, you can make this election right now to be retroactive for 2020. In doing so, there is a process that you have to take your tax return through for 2020. There's a revenue ruling. They do give an exception to make that election retroactive. The challenge is that with an S corporation, you have to have reasonable wages. So in this case, we would have to kick you out a $50,000 paycheck before the end of the year to make all this happen. And I think that the 401k plan has to be set up before October 1st. We can swing back to Greg for that clarification. So this planning really should be done, in the second, third quarter of the year, not necessarily right here at year end in the fourth quarter. If we go to the next slide, this really goes to what Greg was speaking to earlier. The graduated tax brackets that you see that we use for federal income tax purposes. You can see with all of these scenarios, the first $99,000 of your $9,950 of your income is taxed at that 10% bracket. The next $30,575 is taxed at a 12% bracket. And then you get into the 22% bracket. And this is where we start to look at the deferral into a retirement plan, such as a 401k. Like I said earlier, when we do tax planning, we look at this federal tax analysis sheet to determine, how much tax savings we can have with certain moves that are made here at year end. We really focus on this, the tax brackets, because after the 24% is the 32%. So you start really getting into, you save a third or more with tax moves when you hit those higher tax brackets. And this really makes sense with deferring when you hit into those higher brackets. I agree with Greg in that once we hit the 22%, that makes total sense of getting a return on your money of 22% from taking it from one of your accounts and putting it into another. I think that's all I had. Greg, do you have any other questions that you want clarified or would like to ask?
Yeah, I'll go back to your point on the deadline for the solo 401k. That also was changed in the CARES Act. And starting with 2020, you have up until you file your tax return to implement a solo 401k for 2020. So the only real deadline, between now and year end in terms of this whole strategy, if you implement the entire thing, would be, getting the subchapter S aspect of it, firmed up before the calendar changes. The solo 401k part can be done all the way out until you file in April, and that's even including extensions. So plenty of time to implement the solo K.
Yeah, and that's good clarification. That goes with making the election to an S corporation because the first tax return you file is an 1120S. And they do have a check the box where you can say this is the election is being made with this tax return. But you go back to that reasonable wage and actually, maxing out the W-2 deferral portion. You want to incorporate that into your wage when you're heading into year end. So really the challenge would be at this point is getting that payroll squared up and the deferrals associated with that payroll. I think that's the big challenge that we see. Usually when we hit December, we push this to the next year because we really need about 8 weeks to make all this happen and to plan and get the payroll set up and started and so forth. So we're really pressing it right now past that point whereby we can do this for 2020 yet. But it is the key points, I think, are, when your income is greater, when your net income is greater than the 50,000, to start looking at this as a possibility and keeping an eye on that. And oftentimes we like to see it maybe consistent for a couple of years because we've had situations where we try to rush into this, the profit might be at $100,000 and then we realized that might have been just a blip and the profits drop the following years and thereby, causing extra cost with an extra tax return and, all the compliance issues with payroll. So really a good steady growth company. There's a little bit more to the process if you're just a sole proprietor and not an LLC. And that's something that I would suggest if you are a sole proprietor, maybe think about forming an LLC, because when you're an LLC, you have this flexibility to do this at year end. When you're a sole proprietor, not an LLC, you do not have this flexibility. So on any new business startups, we usually advise them to be an LLC, sole proprietor, just so we have this opportunity at year end to check the box and flip them to an S Corp.
Mm-hmm.
Any other questions that you can think of, Greg?
No, I would just kind of look back to the example where, you know, the tax went from $40,000 down to $15,000 when you implement this whole strategy. So you're putting $57,000 into the plan. 25 of that is being funded by, you know, the money you're not paying to the IRS. So, you know, it's a good way to look at, when you look at those numbers, you know, a big chunk of what you're putting in your account is money that you would have otherwise given to the IRS. So the net out of pocket, you know, for that 57, you know, is much smaller than the full amount. So, so just to kind of drive that point home here a little bit at the end, that you know, you're keeping your money and not paying it to the IRS, and you still have access to it. So, so with that, you know, that concludes our presentation here. We want to thank you for taking the time out to watch it. We hope that this was helpful. We know that it's a lot of information, so just jot down your questions, and please don't hesitate to reach out to us. I believe our contact information is up there for you to see. We would love to answer your questions and discuss how these solutions, you know, can benefit you in your unique situation. Everybody's is a little different, so, you know, taking time out to actually sit down and talk about it is key to this process. There's no cost to meet with either of us on an initial consultation. And this is a large part of what we do as a firm, but we also do services like retirement planning, investment management, insurance planning, estate planning. We kind of cover and check all the boxes. And, you know, we have other professionals that assist us in that, other partners like Mike, in fully implementing a client's plan. So, so no matter your age, marital status, job, et cetera, it's, you know, it's never too early to start thinking about these things and planning for that successful financial future. So let us know how we can help. We're happy to help. We're here to help. So with that, we hope you have a great rest of the day, and we look forward to hearing from you. Thank you.
Thank you, everyone.